Good afternoon, everyone. Thanks for that, Charandeep. I think I wanted to give a bit more introduction to the panelists here. So I've got this kind of written down, and I think it's important you understand. So firstly, I'd like to introduce Yuichi Murao. So he is the Chief Investment Officer for Equities at Nomura Asset Management, and he has been a seasoned veteran in the asset management industry since 1990, so quite a while. And then we have Atsuhiko Sakamoto. I call him Hiko. He is another veteran from the world of private equity, and he has been with Ripplewood, Bain Capital, and now he heads Blackstone private equity in Japan, basically. And then we have Yuki Soga. So she has been engaged in the Japanese company investments from public companies for about 20 years. She's also the founder of Penrose Japan, a consultancy that connects global investors' markets with Japanese companies. She has also most recently written a book, Sekai Toppu Toshika no Kyotsu Gengo, so which translates as The Common Language of Top Global Investors, published last month, and it is now #1 in 3 categories on Amazon. She has also been a non-executive director at London Stock Exchange listed fund, partner and Tokyo rep of Indus Capital Partners, which is a New York-based hedge fund investing in Japan and Asia. So with that, we mentioned before, post-COVID, Prime Minister Kishida announced his commitment to an economic policy of a new form of capitalism. Now, I'll begin with a few facts to kick off about the macro landscape of Japan, which is relevant to this panel discussion. So, Japan has had a slow but a steady growth in real GDP over the past 3 decades. Yeah. Now, despite a declining birth rate, the labor force population is at its highest in the past 3 decades. Yeah. And a lot of that is attributable to the rise of female participation, which now is almost touching like 45%. And that's the highest in about 3 decades again. Yeah. So if you look at that, I was looking at the graph of that, and I'd be impressed with the Sharpe ratio of that. For those of you in finance know what Sharpe ratio is, basically. So the year-on-year on CPI for Japan has been hovering over 0% for the past 3 decades, but over the past, recent 2 years, it has shifted into healthy positive territory. It has even touched 4% a year ago. Right now, it's about 2%, right? Then, we might be seeing a normalization of the BOJ's monetary policy. That is yet to be seen, whether they will move away from negative interest rates. And then, there's after the TSE's recent 2023 policy initiative around rules like price to book ratios and cost of capital and so on. I want to see what kind of improvements we will see in corporate governance for Japanese companies, basically. So then one more aspect is, like we all know, this is a well-known fact. There's a staggering amount of liquid cash and deposits sitting with household assets and even with corporate retained earnings, basically. So the Prime Minister has stressed that Japan needs to overcome underinvestment in R&D. He has also most recently asked for Japanese companies to kind of increase wages at a faster pace. So, having said all of that, my question first will be for Murao-san. About 2 years ago, I know that Nomura Asset Management has launched Project Bridge. And could you give us a brief about what Project Bridge is and how this kind of ties into the new form of capitalism?
Well, thank you very much. Good afternoon, everybody. Thank you very much for having me. I'm with Nomura Asset Management for the last 34 years, actually. And the Nikkei's current price is really, really something that I wanted to see for many decades, actually. So 34 years was high, which at one time we never thought that we could see again. However, 2 years ago, we were actually wondering why Japanese market has been so neglected by global investors. And despite the fact that there were many, many good investment opportunities in Japan. So we determined to start some sort of a promotional initiatives, which we call as the Project Bridge. In this bridge, we wanted to be a bridge between the overseas investors and the Japanese investee corporations. And we also wanted to bridge the gap between the Japanese corporations' intrinsic value and the current market value. So we basically think that the Japanese market is very undervalued. So we want to be responsible investor and to through the engagement, constructive engagement with the investing corporation. So there are two big pillars for this project. And so we 2 years ago, 2022, we visited many of the European countries and North America and Asian countries to see in total roughly 300 investors globally, and got some assessment about the Japanese market that they have no interest in Japan because at that time, Japanese yen fell so sharply that everybody is scared about putting their money into any Japanese assets. And people's interest was really about how the BOJ would deal with this or how the currency level would be. So no interest in Japanese equity market in 2022. But moving towards the 2023, there was some increasing interest where we saw some questions, more positive questions, and especially when the Chinese economic outlook got soured, and especially when the Japanese corporate profits really appeared to be very good, faring very good, supported by the recovery in the Japanese domestic economy, and also partly supported by the weak currency, and also there are very famous investors like Warren Buffett visiting Japan to see the investing corporation there. So last 2 months we did some webinar towards the investors, and we take all the feedbacks from the attendees and get how many people are actually very positive on Japan or not. 2022 was only 20% of the people were positive on Japan, but 2 months ago, 80% of the people were positive in Japan, which was a very nice development. And what we do over the last 2 years is to introduce the investment opportunity in Japan, especially on the bottom-up side, the individual corporations. Corporate governance change is really something that is unique to Japan, and how we see the real progress is underway with our investee corporations, and how we see these developments under the current policy is evolving, changing the landscape of the Japanese corporations. And I think that is going to be playing out as some more interest from the global investors. Even though there are still many investors who are still skeptical about this sustainability of the Japanese market. And so this is something that we, as well as the Japanese investee corporations, needs to prove that this is going to be sustainable before we really got the more appetite from the global investors.
Thank you. We will come back to some of the points. I just want to go on to Hiko. So, traditionally speaking, private equity is I consider an alternate form of asset management. In this case, basically companies, right? So it has been that arm of the industry which seeks to create or unlock value in assets by actively managing them, right? In this case, we might call this some sort of shareholder activism, except that you do it by taking over management, basically. So the end goal being to maximize shareholder returns, yeah? Historically, this is not the way most Japanese companies have operated. You can agree, disagree with me, right? The focus has been that not just maximizing shareholder returns, but to take into account benefits to society, to other stakeholders like business partners and even employees, basically. So I personally do not think that pursuing shareholder value should be looked down upon, but because that is sometimes that is what propels innovation, is what I think. Reducing costs is not necessarily about money, but it's about effective use of resources responsibly, basically, right? So in your perspective, Hiko, right, how has private equity helped unlock value in Japan, and what do you think going forward?
I get a lot of questions from our investors. How do we approach investing in Japanese companies on the private side? And I give this maybe massively generalized framework. So in Japan, what the Japanese corporations are for, the main goal is survival. The KPI is just enough profits to make the survival happen. And the employment system is lifetime employment, seniority-based, and very few lateral hires, just no new blood coming in along the career. And compensation is basically cash, base salary plus some bonuses, but very little equity. So the end goal, and then the most important stakeholder is employees and former employees. This system or the notion makes companies very anti-risk, very risk-averse, very hard for the companies to take risks. Whereas if you kind of think about more U.S. capitalistic companies, your goal is basically growth, and then you have to grow. To achieve growth, you innovate, you take risks. And the employment system is very much fit for purpose. You build your team fit for the stage of your growth, and you compensate the people with cash, but also equity. And then the most important stakeholder is equity holders. Therefore, the system notion really pushes for risk-taking and growth. And that's a very contrasting systems. So when we approach to Japanese companies, how can we change that notion of conservatism? Because what's important for us to maximize the value, we have to let the company to grow and reach for the full potential of these companies. So we co-author and co-develop the strategy, not just for creating enough profits, but how can we reach to the maximum potential for the business, and how can we grow? And then build the management team around the vision. It's not so much about wiping out the existing management team and switching with others. It's very, very difficult to do that in Japan. But we surround the people with right qualifications. So the CEO is the right person because he's a cultural carrier. He's run the business for 25 years. That's great. But he misses the capability for the marketing, for example, or the digital science. Then we bring the best people from outside and add that as a team. And then we compensate with people with normal compensation, but with a lot of stock options. That creates the system of just creating enough profits for the next year, the 2 years out, 3 years out, but create enough incentive for the management team to the faster growth. And that's the idea that the private equity funds bring to the table to Japan. So for example, when we bought a business, over-the-counter business from Takeda Pharmaceuticals 3 years ago, we bought the business. It's a pure non-core business out of Takeda for $2.4 billion. That was a very typical risk-averse business run as just for enough profit for the next year. They are making enough profits to pay the dividend to the parent, but not really taking risks to grow, to reach to the full potential of the business. We came in and we put the 4 pillars of growth. 1, reinvest the capital to regain the market share, invest enough in the marketing and rebate program to gain shares domestically. Number 2, build D2C channel, direct-to-consumer business. 3, go international. There's enough business in popularity of the brands that the business had with Asian populations. Let's build an international Asian business. And 4, buy businesses. There are enough direct-to-consumer businesses owned by founders that could be acquired by the business and plugged into the platform. None of it was able to be executed under Takeda umbrella because Takeda didn't want to invest a dime into this business to grow. When you think about building a D2C business, initially you have to hire people with experience to do that. And the second, you have to invest in initial customer acquisition, which creates a J-curve. Because initial 3 years, the top line grows, but you don't make profits. Under Takeda, it was impossible to make that kind of decision. Build international business, again, you have to build organization outside of Japan, hire best people to do that, and then integrate them. Again, that's a lot of resources on the management time as well as the P&L. Again, Takeda didn't want to invest into that. And then lastly, M&A. Again, Takeda didn't want to put any more dollar to make acquisitions for this business. So if you look at the potential for the business, it got a number one brands across in some of the categories in OTC. It got popular, brand recognition of 90% of the Japanese population and increasing popularity from the Asian population. But there was not enough risk-taking culture, both at the Takeda at the subsidiary level, to realize that. So we came in and we authorized the management team to spend more money on marketing in Japan. When we bought the business, the market share of the business in the vitamin category was 19%. We just finished February. Our market share is 36%. So within 3 years, we basically doubled the market share of the category. D2C business, we hired the best talents with the experience and built a team around it. The team didn't create revenues for 6-9 months. But after that, we launched the D2C site, and now it's growing at the double digit. Today, we have $60 million business. It's almost a break even. Again, we are patient enough to let the team grow the business. But now we are break even, and from there base, I think it will grow, and it's going to have a very nice, profitable business. And this is important because in a traditional OTC business, traditional sense, it's 100% drugstore chain, more traditional retail-oriented sales channel. But as the consolidation happens and also online retail happens, you have to build your own channel. And again, that's a forward-looking investment. But under our ownership, we are able to do that kind of stuff. International side, we bought the business in Taiwan and integrated the sales and marketing organization. Again, we had almost zero revenues in Taiwan 3 years ago. Today, we have $50 million in revenues. With the inbound tourism, we have about $100 million of business for the Taiwanese. So that's a significant step, and we are looking at similar situations in Asia and Thailand, really investing into the future growth. And then lastly, we are able to make an acquisition in a D2C side to really scale up the D2C business. So when we bought the business had about 13 billion yen of EBITDA, so call it $130 million EBITDA. This fiscal year, just finishing up, we are about to make $250 million EBITDA. So basically almost doubling the EBITDA of the business. So this is not to just brag our achievement, but this is an example that how the cultural shift under our private equity culture can make a significant impact in these Japanese businesses. So we focus on buying unloved non-core businesses out of large Japanese companies and put more risk-taking cultures and help them with investing more into their businesses and grow. So that's how we see there's a big chapter for the private equity business in Japan.
That's an awesome example of what you did with Takeda. And so yeah, I mean it's great to see. I mean I hear the Project Bridge story about listed companies and how you showcase that, and then how you're doing it in the private equity world, right? Which is not something which the common man has access to. But I think there seems to be some projects which work between traditional asset management and private equity as well, where even retail investors can have access to it. But maybe you can talk about that in a bit. So I just want to continue on the same line. So again, this is a question for Yuki, but we know that it has always been a challenge to showcase the investment opportunities in Japan, especially to overseas investors. So the aim of Penrose also overlaps with that of, say, Project Bridge, and in both of them kind of wish to plug these gaps in the understanding of the potential of Japanese companies. So maybe if you could highlight to us like what 2 factors you see that contribute to these gaps and how they can be sort of resolved. Yeah, I mean after you maybe you guys can also give your views as well on this. Yeah.
So there are various issues, but one biggest one I see in terms of like gap between the international investors and Japanese companies is the communication. So just to give a very, very background that we couldn't touch upon, but I work with various global funds who want to and interested in investing in Japan or doing business with Japan, and just help them have an entry point to understand and identify the target. And I also work on the company side as well. But here I'm not talking about communication as we don't speak English. Language doesn't matter. It does matter, but it's not really the first point. It's about the Japanese company really does not talk the language of the capital markets. It's been touched upon already, but the lack of this sort of like, shareholders or like the investor make the understanding about investors making the investment to return, to generate return. I think the Japanese company have like a lack of understanding. It's not neglecting, but it's just like lack of knowledge. So, for example, things are changing thanks to the corporate governance code. Code has been implemented like about 10 years ago, and then now investors talk about, hey, companies like you have to do better. What about capital allocation, etc., etc. The investors have been pushing the companies to think about it, over the last 10 years. So the more companies who appreciate have to communicate and think in a way of capital market, but majority still think about those qualitative issues like, retaining employees, keep them happy, relationship with the suppliers or the counterparty, which has been in the last 100 years. So you don't want to screw them by implementing price hikes that would cause them trouble, etc. Just give one example of the company wasn't talking the language of capital market is there was this one company when I was working for this hedge fund several years ago. We invested because it was so undervalued based on the fact, the market was taking up, the earnings are growing, balance sheets were cleaning, they can pay more dividends, etc., etc. We could foresee it. And thankfully, the investment worked. But we just still think like the balance sheet. And so, hang on a minute, they've done so well. They got this cash. They paid a little bit more dividend, but still doing nothing with this huge amount of cash. And, ROE is getting lower because of huge equity. So we decided to write a letter to the company to say, hey, congratulations for the achievement in the last a year or two. You've done so well. No, you're in different game. You got cash. You should invest. You should return to shareholders. And there's so many things you can do. And the answer from the management is, no, we're going to hold on to the cash. But just so much. It's like half the balance sheet with the cash. They're like, oh, in 2008, we almost went bust. So we want to reserve the cash just in case something really bad happens. We don't want to die. We want just hold on to this as an insurance. And then in the end, the CEO said to us, you know what? You are the outsider. You just want to make money out of us. You have no right to have, you don't have the right to say what to do. It's our money. And then the senior guy I was in the meeting together was like, that's not your money, it's shareholders' money. But, this guy just didn't get it. But this is a very sort of good example of how the Japanese company had become. I'm not saying everybody, but many in the last 30, 40 years of deflation, we hadn't seen the growth, balance sheet go worse, business wasn't growing. So it became so risk averse, and thinking about capital market way was just totally beyond them, and it was almost irrelevant. So I've been trying to get the investor side, understand the situation. That shouldn't be the case, but you have to be patient and have to work along with them. And I've been saying to the companies hey, look, the investors put in money not for you to hold on to it, you have to maximize it. You have to, investor needs to make money, and that's the capital market. So that is something we are lacking. And the solution, I think or differently, this corporate governance thing is more of the thing in Japan. Companies are starting to understand, and shareholders putting pressure or they engage and trying to advise. So I think more of the dialogue between the companies and the investor would help the Japanese market a lot. And you might get resisted, but with the patience and relationship, company will eventually appreciate that. So if you are an investor to Japanese companies, I do highly encourage just engage with the company, with the patient, you will see the result. The second point I'd make is about the business culture. It is related to the first point and related to the point being already made. But there's so many factors that are, I would say, like only in Japan. Like good example is about this price hike or the wage hike. Those things are finally happening in Japan thanks to the inflation that is happening for the first time in millions of years. But fundamentally, these are not the things Japanese companies are very used to. Of course, the prices were going down. But this is something, it's just so beyond overseas investors understand. Given a good example, there was this like raw material which was used in the semiconductor industry. This is no story right now, but like several years ago. And only this like Japanese companies and another one could make and had like a very high market share. But the demand for semiconductor was growing so much. And then these materials was in a very high demand. And then the factory was operating at full capacity. And adding a new capacity to this material is a huge investment. So company had to think really carefully about it because of the cycle and everything. But despite this huge demand, high market share, the company wasn't hiking the price. It's just because like in some of the customers were overseas, but some of the customers are like the domestic counterparties. So like, wow, like our customer has been buying from us for like last 50 years, asking like price hike is kind of we are worried about jeopardizing relationship. And in fact, we do not have the price cut when the downtrend comes. So we shouldn't make a demand, they shouldn't make a demand. That was the mentality. Something like that. It's like overseas investors like, come on, there's demand. You have market share. Why not hiking the price? It must be like something is really wrong with the business. That's how the overseas investors perceive and just don't get there. Then get to the point thinking like, okay, it sounds interesting, but we are not investing. So it's a shame, So, of course, companies should explain the Japanese business dynamics and how it works slightly different from the Western country. But it's something Japanese company has to start a little bit better about being competitive, make more money. It's business, it's capital market. So yeah, it's again going back to the first point about communication and think in a capital market way. But at the same time, I guess on the investor side too, it's sometimes maybe when you make business or investment in Japan, things are different and you might feel a little bit uncomfortable the way things are carried out. But in some cases, it actually works out really well. So maybe somehow, appreciate a little bit and acknowledge and accept it as it is. That could work sometime too. So
thanks for that, Yuki. So, one of the points you mentioned that they don't want to transfer the price increase. I've also heard this from someone else because they were saying that there is the kind of sushi restaurant. And we know that even in Japan, they kind of importing the fish, importing salmon from other places, right? And with the dollar and where it is, instead of trying to transfer the price and increase the price to their customers, the sushi shop decided to shut themselves down because they thought, they were too. I don't know what the word to use is. They said, no, I can't do this to my customers. I rather not do anything than just increase the price for this. Now, I don't know whether that's a good thing or a bad thing, but what do you think? Murao-san, do you have any thoughts on these things?
Maybe due to the long-lasting deflation in Japan, I think the sort of mindset of the top management really is accommodated in a way that they can deal with this deflation. So everybody didn't want to raise their prices because of these threats about the losing market share and so forth. But I think the beginning of the situation is really the consequence of the bubble economy. in 1980s, late 1980s. And at the time, the Japanese economy was so growing so fast that everybody thought that would last forever. And we built up lots of stores, lots of restaurants, lots of factories, and lots of, many things. And that could result in oversupply situation of many things. And that was the root cause of the long-lasting deflation. But over the last 20 years, we did see some reduction of the capacity. We cut some capacity. We saw a consolidation. And we are now seeing the normalized situation where we see the balance of the supply and demand many places in Japan. That, I think, is one of the reasons that many increasing companies are now able to charge higher prices in the markets. And the most importantly, I think the structural demographic problem is now having some effects in everywhere. As you mentioned at the beginning, that the labor population in Japan has been rising until 2020, thanks to the more female workforce, and also the senior elderly people came back to the markets after his retirement, and they continue to work until the age of 65 and 70. But finally, in 2023 and 2024, we expect that the entire labor population in Japan would start to decline. And this is something that we are seeing everywhere. And so the shortage of the labor force is really becoming the serious problem for many companies. And unless you can really have a sufficient number of the employees or workers there, they are now in the face of the bankruptcy. We are seeing still a very, very accommodative monetary condition in Japan. And we have a historically low level of the unemployment in Japan. Nobody is having difficulty to find their jobs. But the bankruptcy cases are rising in Japan right now because of some reason that they do not have the successors, they don't have enough workers there. So that they have to raise their salaries or the wages to acquire these people to continue the businesses. And I think this is a kind of very, very structural and transformational change that we have seen, in decades. Some of the overseas investors said that we do not want to invest in Japan because there are lots of zombie companies in Japan who do not really create a sufficient level of return on equity, and they are listed. They're still there. But now we are now under pressure where the market force in terms of labor market force is now putting some companies who are not able to afford these people to get out of the market. And then we also see some, increasing number of the M&A where we see these, weaker companies are acquired by these stronger companies. So I think this trend is something that is entirely different from the past cycle where we saw some, short-term rally in Japanese markets. And that's something that we want to deliver to non-Japanese investors who do not really have enough information.
We know that the Nikkei is at all-time high basically right now, and the dollar yen where it is 150. Do you think this is, what is the sweet spot for dollar yen? I mean, each of you can give your views, and what do you think of the dollar yen? I mean, do you think it's 135, 175 where it is right now as well? What is that good for Japan, or does it hurt Japan? And what do you think about it, kind of thing? There was one more question I would ask, but it was about what industry sectors do you think we were underinvested in, kind of thing, and which is cheap, and you think there's that's something which needs people to invest their funds in, basically, sort of thing.
Sure, I'm just going to answer your question in a slightly different way, but to me, it's all about incentives and why the Japanese companies started acting differently, because the system changed, because the corporate governance code or the Tokyo Stock Exchange initiative to basically shame the companies for undermanaging the balance sheet. All these things giving the activists tools to be successful. And a number of public activist campaigns being successful, putting more companies and pushing the companies to optimize the businesses. And again, the Japanese system is built for survival. And now, these companies, to survive, they have to optimize the business in the public markets. Therefore, they started taking right actions. And so I think with all the systems in, you started seeing the early success of the activists. I think you see more and more campaigns to come through in Japan, and that will push the Japanese companies to perform better. And I'm very optimistic that now it's, Nikkei is high, but not the broader market reality, but I think the more and more companies will start taking more actions to optimize their business because of the external pressures to survive. So I'm very optimistic for the market in general.
First question is about the exchange rates, and our official view is 135, 140, but could be wrong. I mean, and last month we did some analysis survey to our clients, and 100% of the people thought that the Japanese yen should appreciate, mainly because of the Fed rate cuts expected in second half of this year or next year. That could be wrong. Japanese yen, 150 is extremely cheap, as many of the people here would aware that you can cheap everything in Japan, and I think that's crazy. But there are some structural changes in Japanese industry structure and the financial behavior of the household sector. So the 150 level could be sustained for a while. And about Nikkei, I think Nikkei is still very much attractive because of a very reasonable valuation. And if you compare the valuation of the IT bubble or the past Japanese bubble, their valuation is crazy, 60 times of the PE or whatever. But now we are only seeing 15 times, 16 times, which I think is very reasonable. And about the industry sectors, I think there are many Japanese companies who we call as an enabler in terms of the technology to the semiconductor chips. People love NVIDIA, Micron, Intel. These are the chip giants. But these giants can build their factory only if they can acquire the machines, semiconductor equipment machines from Japanese corporations. Japanese corporations have a pretty much high market share in globally, 80%, 90% share of these SP semiconductor production machines and some functional materials and so forth. So this is some area that you can see to make some investments.
On a currency, my answer is I have no idea. And it's $1 million question. I wish I knew the answer. And of course, Nikkei, I have very similar opinion to two gentlemen. But one thing I would say is I had always been actually very cynical towards Japan, and I was there. And when I was working for a hedge fund, I actually enjoyed shorting quite a lot. But now seeing these structural changes and governance improvement, it's great. We are not the perfect country yet, but changes are happening and it's starting. That means it leaves plenty of upsides to capture from here. So I have not been as excited about finding an opportunity in the Japanese market, whether it's private, public, it doesn't matter. We are a country with IPs, good workers, education. We've got so much gem, but we hadn't advertised. And, we're cheap now because thanks to the weekend. So, I think it's such an exciting moment for Japan. And finally, on the sector, I think technology is one thing, and this is FinTech conference, and people are faced to the cutting edge technology. But I think there's so many good older companies which have been around for decades, providing with the good same qualities and service, and which can go global but has just stayed in Japan. So if you can identify these companies and you international people engage well, actually you can bring it to global market, opening up the new sort of a new way to sell, and then sort of create new corporate value. So that is something excites me, and not a specific sector, but there's so many ways you can actually create value out of Japan.
Thanks so much for your views on this, and hope we've learned a lot from you guys. Thank you.